Hey guys, hope everything's going well. You guys know that drill. Smash that like button, subscribe if you haven't, and comment down below. Today, I wanted to touch base on why I still believe the Federal Reserve is going to pivot, and on top of it, why I believe if they don't pivot, they're going to stop raising interest rates. It may not happen after this coming September meeting, but ultimately, still see this occurring down the pipeline, or it's going to be happening, in my opinion. Why do I see this happening? Well, first of all, you have all these guys at the Federal Reserve saying, hey, we want to curtail inflation, 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 inflation. And if you looked at what happened during the Russian Ukrainian situation earlier this year, oil hit $130 a barrel. And now it has come down, what, to the 80s? And we haven't seen that in quite some time. And it's good to see when I go to the gas station that I'm not spending like what 70, 80 bucks to fill up our car. I mean, it's gone down. I mean, obviously, it's not where it was in 2020 when oil prices were actually negative in the futures market for a month. Or I think it was for at least a few days, right? It was what, negative $40 a barrel? It was insane. So that was good times when it came to groceries. Now, what's happened is that things are getting back to normal, and all these companies have to deal with the ramifications they dealt with during the pandemic. And not only that, you have sanctions worldwide, and you have to look at wheat prices. Wheat prices lead to increase in food inflation throughout the US and also the rest of the world. Now, here's the thing though. If you have all these interest rate hikes that we've seen, we're at what, 4%, that means the cost of credit has gone up. Now, the rich will always be able to finance their activities. But when it comes to the middle class, you could say even upper middle class, lower middle class, a lot of them have credit card debt. And the credit card debt interest rate goes higher and they have to pay more. And we're in a situation where, okay, the economy isn't as great as it was before. And on top of it, you have to look at some layoffs, specifically the tech industry. You're seeing some layoffs there. I read that Patreon is getting rid of its security team, right? Of all places. So you're starting to see some impact to the job market. Does it mean that the whole system is going to crash right now? No, I'm not as bearish as some of the media was, but ultimately, in my opinion, this pause should give a rise to the stock market, to specific precious metals, to crypto, to the collectibles markets that I'm in. And I think next 1-2 years would be a good opportunity to take profits. Not invest. This is not investment advice. This is just me thinking out loud. I think this would be a better time in the next 1 or 2 years if we see the appreciation of these assets to take profits, probably go into cash, and instead of inflation, the new talking point, in my opinion, if everything comes unwinding down and you see a crash, they're going to say deflation, deflation, deflation. Right now, they're saying inflation, inflation, inflation. And I believe there will be an oil spike, but that oil spike will lead to probably a deflationary crash that we saw in 2008, 2009. Remember, oil hit $30 a barrel. The US dollar index hit 89. But going back to today. So there has been word that other countries are going to relax on raising interest rates. And the theory behind all these rate hikes is to save for a rainy day. And now what the Fed funds rate is going to be over 3%. What can you do with that? If economic conditions are a bit tough, you could lower interest rates. Easy money. Easy money will pump up the markets. Whether we like it or not, that's what usually happens. They did lower interest rates, I think, in 2006, 2007, but that rally was short lived. I do believe that if they do that again, this rally will be short lived, but at the same time, this will provide an opportunity for people to take profits. And I think some of the boomers are going to be taking profits in the next 1 to 2 years, just based on trends. So I'm just looking at it, okay, you lower these interest rates, then it's going to pump up the markets, dollar index goes down, and everyone's going to be happy. I believe that if I am correct, what sector is going to benefit the most out of this is going to be the tech sector. The tech sector has taken a hit. Like I mentioned, there have been layoffs in tech, and they have been pretty tight with their money lately. I was reading something about Google, or I was watching a video on Google and how the CEO is going to be a little cautious in how he spends. And if you're just looking at that, I'm thinking, okay, lower interest rate environment, meaning if the 10-year rate also goes lower, that should be another reason why some of the speculators will probably go into FANG stocks. Because they were always talking about FANG, right? And then the interest rate hikes came, and then no one was talking about FANG. Everyone was talking about getting defensive, going into the dollar. But now that trade, in my opinion, is overcrowded. And some people will be like, hey, look, there's problems in China. Yeah, there are problems in China. Yeah, the lockdowns are not good. But at the end of the day, you have to look at the composite of the dollar index. The dollar index mainly consists of the euro. I'm saying this again because a lot of people don't realize this, right? So if the euro goes down in value, if the euro goes up in value, there's a higher probability that the dollar is going to go down. And the ECB has an inflationary nightmare in the sense that they have ridiculous amounts of inflation because of their dependence on Russian energy. And two, you had the pandemic. So putting all these things together, they're going to raise rates, and they're not going to raise rates as aggressively as the US. So I do see bullish outcomes. Now, there probably will be more volatility in the in the coming weeks, I would presume, because number one, you have the Fed meeting, so people are going to get a little nervous and jittery about that. You have the other not outcomes. You have more interest rate hikes later this year, and also you have the elections in November. So there will be volatility, but in my opinion, if we do see that volatility, it will be buying opportunities, in my opinion. I'm not telling you what to buy or sell. That's your choice. And, if you need help, go to a qualified financial advisor. But yeah, those are my thoughts. Fed should pivot, and I think that's going to be, for me, a good way to get out of the market in the next 1 to 2 years. But anyways, guys, let me know what you think. Remember to smash that like button, subscribe if you haven't, comment down below, guys. Thank you. Bye.